Welcome to today's deep dive. We have a really fascinating one lined up for you today.
We really do, yeah. It's quite a wild situation to unpack.
It really is. So I want you to imagine for a second that you are, just scrolling through a stock screener. You're looking for a hidden gem.
Like we all do, right?
Exactly. And you pull up the financial statements of this one company. And the top line revenue numbers are just so aggressively positive that you actually have to stop and refresh the page.
Just make sure it's not a glitch.
Yeah, literally to make sure it's not a typo. Because we are talking about trailing 9 months revenue hitting an astonishing $4.6 billion.
Which is just a massive number.
It's massive. That is a 206% jump compared to the exact same period last year.
Oh, wow.
Right. So naturally, you would think the market is just throwing an absolute parade for this company.
I mean, you'd assume Wall Street is just tripping over itself to buy shares.
Yeah.
Triple-digit revenue growth at a, multi-billion-dollar scale.
Right.
That's like the holy grail for a growth investor.
Yeah, absolutely.
Usually when a company proves it can scale revenues that fast, the market rewards them with a massive premium.
But the reality here is it's a massive paradox. Instead of a parade, the market has taken a sledgehammer to this stock.
A complete sledgehammer.
Over the last year, shares are down over 77%.
It's just collapsed.
It has completely collapsed from its peak.
Yeah.
So today we are taking a deep dive into an equity research report on Fubo TV Inc., ticker symbol FUBO.
Right.
And the mission for you today, as you listen to this, is to really decode this bizarre disconnect. Like, how does a company pull in billions of dollars, grow its top line by over 200%, and still watch its stock price just fall off a cliff?
It's really one of the most brutal lessons in modern corporate finance, honestly.
Yeah.
To understand what's happening here, we have to look past the flashy headlines that are, sort of designed for retail investors.
Right. The stuff that makes you click buy.
Exactly. We have to figure out what the institutional market is actually seeing. Because those massive top-line revenue numbers, they are actively masking a structural crisis.
A crisis on the inside.
Yeah, because the market, for all its daily volatility and noise, it is ruthlessly rational about one underlying truth in the long run.
Which is?
Actual cash in the bank.
Yeah, cash is king. And we have to start right there with the core financial numbers from the third quarter of fiscal year 2026.
Let's get into it.
So Q3 revenue hit $1.482 billion globally. And like I mentioned, the trailing 12 months revenue growth is sitting at 206.41%.
Right.
On the surface, the growth engine is just a monster. They are acquiring users, generating massive sales volume, and management is certainly leaning into that narrative.
Oh, they definitely are.
They actually raised their 2026 pro forma adjusted EBITDA guidance to somewhere between $90 and $100 million. And they narrowed their net losses to $25.7 million. So wait, if their losses are narrowing and management just raised their EBITDA guidance, shouldn't investors be celebrating?
You'd think so, right? But those words pro forma and adjusted, they're doing an incredible amount of heavy lifting there.
How so?
Well, management teams, they love to point to adjusted EBITDA because it lets them conveniently ignore the massive, very real cash costs of running their business.
Right, the stuff they don't want you to focus on.
Exactly. When a company adjusts its EBITDA, it's essentially saying to you, here is how much money we made if you allow us to exclude a bunch of the money we actually spent.
Which is a crazy way to run a budget.
It is. It's a useful metric for assessing theoretical operational efficiency, sure. But you cannot pay your bills with adjusted EBITDA.
No, you pay your bills with cash. And that is where the narrative completely falls apart for Fubo TV. Because if you look at the actual cash burn, the operating cash flow for the 9 months ending June 30th, 2026, it was a negative $417.03 million.
Just bleeding cash.
And when you factor in capital expenditures, you get a free cash flow proxy of negative $418.9 million.
Yeah.
So they generated almost $4.6 billion in 9 months, but they essentially bled out $418 million in pure cash just to do it. It's like a blockbuster movie that everyone is buying tickets to see, but the studio spent so much making it that they're still going broke.
That's a perfect analogy, actually. And the underlying mechanics of the streaming business explain exactly why this is happening.
Break that down for us.
So Fubo TV is built on offering live television, right? Specifically sports. And the rights to stream those networks are just astronomically expensive.
Oh, for sure.
The content owners, the major networks and the sports league, they demand massive upfront payments. And they want rigid minimum guarantees.
They hold all the leverage.
They hold all of it.
Yeah.
So unlike a traditional software business where, adding one more user costs almost nothing.
Right. Zero marginal cost.
Exactly. But Fubo TV has a massive variable cost attached to every bit of its growth. The research specifically notes their net margin is negative 0.71%.
Negative margin.
Right. That means they're operating at a structural deficit. The bigger they get, the more cash they consume just to keep the service running.
So they are effectively subsidizing the subscriber's television bill.
Yes, pretty much.
Or for every dollar they bring in, they are handing more than $1 over to the content providers.
Which is unsustainable.
And that leads to, honestly, the most terrifying number on this balance sheet. As of that same date, their cash on hand was only $230.283 million.
And this is where we really transition from talking about cash burn to talking about runway.
Runway, yeah.
Your runway is a strict mathematical calculation. It's just how many months can you survive at your current burn rate before the corporate treasury literally hits zero.
Right.
If you burn through $417 million in 9 months and you only have $230 million left.
You don't even have 6 months of runway left at that pace.
Exactly.
The company is in a foot race against its own bank account. If management raises adjusted EBITDA guidance, but the market sees a $230 million cash balance stacked against a $418 million cash drain.
The market knows the clock is ticking.
Yeah, they see right through it.
The raise guidance is almost irrelevant when the structural integrity of the balance sheet is under that kind of intense pressure. The market is pricing in the desperation of that cash position.
And you can see it. That structural pressure is devastating the stock chart. The research notes the stock recently closed at $10.15.
Yep.
Now, on a very short-term basis, it's actually above its 20-day and 50-day moving averages, which sit around 927 and 946.
Okay, so a tiny bit of momentum.
Yeah, short-term. But you zoom out, and it is trapped in this brutal long-term downtrend. The 200-day moving average is all the way up at 1935.
Wow.
And the 52-week high was 56.64. So it's collapsed 82.1% from its peak.
And we really need to look at what that 200-day moving average actually represents psychologically.
Okay, tell me more.
It isn't just some, arbitrary technical indicator on a chart. It represents overhead supply.
Overhead supply.
Right. It is quite literally a graveyard of trapped investors. People who bought the stock at $15, $20, or $30, and they are now deeply, deeply underwater.
Just waiting to get out.
Exactly. What happens when the current price of $10 rallies to 12 or 13? Those trapped investors rush to sell just to cut their losses or break even.
Ah, I see.
That wall of selling pressure constantly caps the stock's upside, forcing it right back down into that long-term downtrend. It's a ceiling.
But, okay, if you are looking at this from a value investing perspective, I have to push back a little here.
Sure, go ahead.
The valuation metrics in the research are staggering.
Right.
The price-to-sales ratio, the PS, is 0.2172.
Right.
So the market is valuing $1 of Fubo TV sales at barely 21 cents. If the stock is already down over 80% from its peak, hasn't the worst already been priced in?
You'd think so.
I mean, doesn't this mean the stock is basically on the clearance rack for you as an investor? 21 cents on the dollar seems like a screaming bargain for a company pulling in billions.
And that is the exact psychological trap that institutional algorithms exploit. The research explicitly flags this using a very specific term.
The value trap.
The value trap.
Right.
Retail investors look at that $56 peak and they anchor their expectations to it. They think, well, if it just goes back to half of what it was, I'll triple my money.
Right. It's so tempting.
It is. But a stock is only a bargain if the underlying corporate entity actually survives to realize that value.
Because if the company runs out of cash and enters bankruptcy, a stock that you bought at an 80% discount still goes to absolute zero.
Precisely. The institutional money driving that price-to-sales ratio down to 0.2, they aren't blind to the top-line growth.
Right.
They are simply pricing in the probability of survival. The market is looking at that $230 million in cash. They're looking at the negative margins and concluding that the deep discount is entirely justified.
They're not giving them any benefit of the doubt.
No, they are treating the stock like a distressed asset. because the underlying business model hasn't proven it can generate cash without endless external funding.
And we saw exactly how unforgiving the market is right now. Despite the company raising its adjusted EBITDA guidance, the shares fell 6% pre-market simply because they missed their Q3 revenue targets.
Right, which shows you where the market's head is at.
Exactly. For a hyper-growth story, the second you show a crack in your top-line momentum, the market doesn't care about your adjusted earnings at all.
Because that top-line growth is literally the only thing keeping the narrative alive. When your entire valuation is built on the promise that you will eventually outgrow your massive fixed costs.
Any deceleration is fatal.
Any deceleration in revenue shatters the illusion. The market instantly pivots from looking at the growth potential to looking straight at the balance sheet risk.
And that balance sheet risk is severe. But, the red flags in this research go way beyond just the cash drain.
Oh yeah, they really do.
Let's look at the actual behavior of the people running the company. If you are a listener trying to decide if this turnaround is real, trying to figure out if that 0.2 price-to-sales ratio is a genuine opportunity,
You have to look at the insiders.
you have to look at insider activity. And the data here is glaring. There has been one open market sale of 141,074 shares by an insider. And there have been exactly 0 open market purchases. Doesn't that just scream red flag? That the people running the company aren't buying their own clearance rack stock?
Insider activity is one of the most unfiltered signals of corporate health you can find. As the saying goes, insiders might sell their stock for a dozen different reasons.
Like what? Buying a house?
Buying real estate, paying tax obligations, or simple portfolio diversification.
Sure.
But they only ever reach into their own pockets to buy stock on the open market for one reason. They believe the price is going to go up.
Which means the absence of buying is deafening here.
Deafening.
The stock is down 80%, supposedly trading at a massive discount. Yet the executives who see the internal cash flow projections every single day aren't buying a single share.
Right.
That speaks volumes about their confidence in the near-term runway.
And that lack of confidence connects directly to the board-level decisions detailed in the report, too.
Right, the board changes.
The research highlights the recent appointment of CEO Elisa Bowen to the board. And that came alongside the approval of an expanded equity incentive plan.
Which sounds pretty standard on the surface.
On the surface, it sounds like standard corporate governance, sure. But if you connect an expanded equity plan back to a company burning $400 million with only $200 to $30 million in the bank, the mechanics of dilution become a serious, serious threat to the everyday shareholder.
Because they have to pay their executives to retain them, right? But they literally don't have the cash on hand to pay out massive cash bonuses, so they pay them in stock.
Exactly. When the corporate treasury is running dry, they compensate leadership by printing more shares. It's essentially paying executives in IOUs drawn directly from the existing shareholders' equity.
Wow.
If you own a percentage of this company, every new share they issue to an executive dilutes your ownership stake. Your slice of the pie gets mathematically smaller without you doing anything wrong.
It's like a death spiral. To survive, they either have to issue more equity at deeply depressed prices, which punishes current investors,
Right.
or they have to take on high-interest debt, which just accelerates the cash burn even faster.
Neither option is good.
And as if the financial engineering wasn't precarious enough, they are trying to manage all of this while fighting off a major legal threat.
Yes, the lawsuit.
The report highlights an ongoing patent lawsuit from Adia Inc., which was filed on July 1st, 2026.
And patent lawsuits are uniquely dangerous for a company in this kind of vulnerable position.
Because of the cost.
Because they are notoriously expensive, yeah.
Yeah.
They drag on for years. They require specialized, high-priced legal counsel. When you are desperately trying to stretch $230 million of runway, you absolutely cannot afford to have millions drained away by unpredictable legal fees.
Not to mention the operational risk. Like, if Adia secures an injunction, or if Fubo TV is forced into a punitive settlement,
It could be devastating.
it could directly disrupt their core streaming technology, or add another massive, unexpected cash liability to their balance sheet. It takes a situation that already requires flawless execution and introduces a completely uncontrollable variable.
Which is exactly why the execution risk here is classified as extraordinary in the report.
Yeah.
You have a structural cash burn, an unforgiving macro environment for raising capital,
Yep.
a chart dominated by trapped overhead supply, looming shareholder dilution, and a patent lawsuit draining resources. It's a perfect storm.
So given that overwhelming wall of risk, what is the actual roadmap out of this? Like, what is the light at the end of the tunnel that management is promising?
Management is projecting a very specific timeline to turn this around.
Okay.
They've stated their ultimate milestone is achieving positive free cash flow by 2027.
2027?
And looking even further out, they have a 2028 target of generating greater than $300 million in adjusted EBITDA.
But the timeline is where the rubber meets the road, right? Setting a target for positive free cash flow in 2027 sounds great on a quarterly earnings call, but bridging the gap between today's reality and that future state is a monumental task.
It's huge. And this is exactly why the overall assessment rating in this research report is a 4.
A 4?
Which is a strictly neutral stance. The analysts are looking at the math and refusing to take a definitive bullish or bearish position until management proves they can actually execute on this.
Because the math is incredibly tight. They want to be cash flow positive by 2027, but they only have $230 million in cash today.
Right.
How on earth do they bridge that gap without asking the market for more money? I mean, the next 6 to 12 months are absolutely critical. Hitting revenue targets is just no longer enough to satisfy the market?
No, it's not. The medium-term horizon is everything right now.
So what are the specific inflection points management has to hit in the upcoming quarters to prove this isn't just a value trap?
The first and most vital turning point is a sequential reduction in operating cash outflow.
Meaning they need to literally spend less cash.
Yes. It is not enough for management to say that losses are narrowing based on some adjusted accounting metric.
Right.
The actual literal cash leaving the bank account needs to drop significantly quarter over quarter. The next few earnings reports aren't just about hitting revenue numbers anymore. They are fundamentally a ticking clock to see if management can aggressively cut that cash burn before the runway disappears.
They need to prove they can shrink that negative $417 million number aggressively. But here is the catch-22 of the media business. How do they do that without destroying their top-line growth?
And that is the second inflection point, and it is brutally difficult. They have to maintain sustained revenue growth while simultaneously slashing costs.
Which is almost impossible in streaming.
It is, because in streaming, your primary costs are content and marketing. If you cut your marketing spend, your subscriber acquisition plummets. If you try to negotiate cheaper content rights, you might lose the very sports channels that your subscribers are paying a premium for. If revenue drops because you cut costs, the margins compress even further, and the entire thesis just collapses.
It's an agonizing balancing act for them. And finally, I assume they need a clear, definitive resolution to the IDEA patent lawsuit to remove that unpredictable financial overhang.
Absolutely. They need that off the board.
If they can somehow thread that needle, if they can cut the cash burn, maintain the subscriber growth, settle the lawsuit, and actually hit that positive free cash flow target in 2027.
Then the upside from a $10 stock price is undeniably massive. That is exactly why they are dangling that $300 million EBITDA projection for 2028.
The potential reward is massive. But the deep discount in the stock price today is simply the market mathematically pricing in the likelihood of failure against the possibility of that miraculous turnaround.
Exactly. If the cash burn accelerates in the next quarter, or if that free cash flow target slips by even a few months, the neutral rating on this stock would likely downgrade very rapidly.
Which perfectly encapsulates the paradox we started with. To summarize the whole story, Fubo TV is a textbook case study in the extreme tension between scale and survival.
A fascinating case study.
You have a company achieving 200% top-line growth, generating billions in revenue and capturing a massive streaming audience. Yet it is stranded at $10.15, burning through over $400 million.
Facing down shareholder dilution and patent litigation.
With an hourglass that is rapidly running out of sand, it strips away the illusion that growth solves all problems.
It really does. In the current economic environment, growth at the expense of unit economics is heavily penalized.
And it leaves you with a much broader question to mull over, something to really think about when looking at the media landscape.
Yeah, what's your takeaway?
Well, when you are analyzing a media streaming company trapped between the massive cost of content and the desperate need to grow subscribers, At what point does hypergrowth actually become a liability rather than an asset for a business?
That is the existential question hovering over the entire sector right now.
We see a company pulling in $4.6 billion entirely dedicated to the live streaming sports model, and they are still bleeding cash. It forces you to wonder if a pure play company of this scale can't make the fundamental economics of live sports streaming work without running a structural deficit.
Is the entire standalone live streaming business model fundamentally broken?
Right. Is it broken for anyone who doesn't have the trillion-dollar balance sheet of an Amazon or an Apple to subsidize those massive losses?
If the content costs are permanently decoupled from the subscription revenue, the standalone streaming model might just be an unwinnable game.
A fascinating and slightly terrifying reality check for the streaming industry. Something to keep in mind the next time you see a headline touting massive, triple-digit growth. Thanks for joining us on this deep dive.